Welcome to our tax podcast, the Tax Files. And today we have a special guest. We have Renaud.
Thank you for having me.
Yeah.
First time here with us.
It is my first time. I am finishing my law school studies, and I happen to be around. And I heard we were reading the GAAR today.
Yeah. So today it's special. Okay, we're not reading a case. We're reading a web page. So there is this new web page from the CRA on the GAAR, and so we are going to read the web page on GAAR.
Yeah.
You see it now on screen. So this is some guidance from the CRA on GAAR. And I think it's quite interesting that if you look on top, GAAR is part of the How Do We Combat Tax Evasion and Avoidance, which is under scams and fraud.
Oh.
Not to say that we are talking about fraud today.
Oh.
But
Okay.
it is where it is on the website. But this is not any value judgment on the GAAR. Of course not.
I thought it was an anti-avoidance rule, not an anti-evasion rule.
Well, I don't know why they put evasion and avoidance together here, but it's different.
Yeah. Okay. All
So-
right.
Yeah. Okay, so let's start reading this. Okay, General Anti-Avoidance Rule, parentheses, GAAR.
Yeah.
I remember that joke on your Twitter, I think. What does the tax pirate says?
Don't do it. Okay.
GAAR!
So bad. Okay.
I love this. Okay, so my mouse is doing some weird work.
Okay.
Okay, overview. What is GAAR? The Canada Revenue Agency, CRA, is committed to protecting the integrity of Canada's tax base and uses a multifaceted approach to address tax avoidance. This approach relies on communication, compliance monitoring, responsible enforcement, a voluntary disclosure program, and a strong policy and legislative base. I like how the law is the very last part.
Yeah.
Should be the law first. Like, the law is
They're
the
trying
best
to
way.
enforce a view of your relationship with the CRA. Communication. Right.
Communication.
Yeah. Yeah. Okay.
The CRA knows that most Canadians comply with their tax obligations, which is true, eh?
Yeah.
Most people,
Yes.
like 90% plus,
Yes.
are paying their taxes.
They cooperate.
Yes.
Yeah.
Canadian courts have held that, in general, taxpayers have the right to arrange their affairs in a way that will minimize their tax liability.
Name the case, Renaud. Which case tells us that taxpayers have the right to arrange their affairs in a way that will minimize their tax liability?
I know it's seen at Cupthorne, but is it further than this?
Yeah, you have to go
It's
all the way
back.
to basic tax the
Oh.
last day, and you have to think about somebody that hires a gardener and has household staff. Yeah,
I-
and it's a duke.
Oh, Duke of Westminster.
That's
Duke
it.
of
That's the
Westminster,
one.
yeah.
we tested him, and he has passed the test. Good job. Good job. Yeah, phew.
100%. A plus.
A plus. A plus. A plus.
So it is indeed the Duke of Westminster.
Yeah, that you have the right to minimize your tax, and in fact, you have no obligation to pay more tax than what the law requires.
Even though this person might be very ingenious, the CRA cannot have any judgment or say anything against it.
That's right. That is correct.
As long as it is legal. As long as it is legitimate,
Yeah,
legally speaking.
right.
Okay, however, that right has been restricted in Canada by targeted and specific statutory anti-avoidance rules, as well as a general anti-avoidance rule, to address aggressive tax avoidance arrangements that compromise the integrity of the tax system.
Okay.
Okay, that's...
So far, so good. We want the integrity of the tax system to be preserved,
yes.
and aggressive tax avoidance compromise that integrity.
I'm not sure how I feel about aggressive tax avoidance.
It's one of those words that's trying to move us closer to evasion without being evasion.
And also, it's like, if you say it's aggressive, it's already a judgment on the tax avoidance.
That's true. You've already passed
So it's like,
a judgment.
if you say GAAR is for aggressive tax avoidance, like GAAR is for GAAR. It's like,
Yeah. It doesn't
Yeah.
say general anti-aggressive avoidance rule.
And it's not part of this either.
Right, right.
There was no
It's not a factor.
aggressiveness.
Oh, we already have complaints about what's in here. Oh, sorry.
One paragraph in, that's like, yeah. Okay,
Okay.
purpose of GAAR.
All right.
The GAAR strikes a balance. Oh, that's striking. Strikes a balance. Hashtag Justice Woods.
Yes, yeah, exactly.
A balance between protecting the tax base and taxpayers' need for certainty in planning their affairs.
Yeah.
Its purpose is to deny tax benefits to any taxpayer that, although complying with the literal reading of the provisions of the tax rules, are not in compliance with the object, spirit, or purpose, sometimes and, of the legislation.
Yeah, sometimes and, sometimes or. We're inconsistent on this. Object, spirit, or purpose, or object, spirit, and purpose. You see it both ways in the cases, yeah.
The GAAR can also apply to tax avoidance transactions undertaken to secure tax benefit afforded by tax treaty. Oh, tax treaties. Huh, interesting. What else you should know about GAAR? Is it like the main part is
It's like the more you know.
4 paragraphs,
Yeah.
like what else should you
Well,
know?
what else should you know?
I don't know.
All right.
High tax people, what else should you know about
What-
the GAAR?
Everything you thought you never needed to know about the GAAR, and here it is. Yes.
The CRA chairs an interdepartmental GAAR
Yeah.
committee that includes the Department of Finance and Justice to ensure the Department of Finance and the Department of Justice, and it sounds like it's the Department of Finance and Justice.
Yeah.
I don't like that wording.
No, I see that. Yeah.
To ensure that the GAAR is applied consistently.
Okay.
Unless the committee has previously reviewed a similar issue or transaction, the CRA consults the committee before it relies on the GAAR as a primary or alternative assessing position to deny a tax benefit.
Okay, so this is always interesting to me. There is a GAAR committee, and if the CRA wants to apply the GAAR to a taxpayer, they first have to run it through the committee. And I guess if it's the same issue that they've already run it through the committee and they see it again, like taxpayers are using the same strategy, then they don't have to run it through the committee again.
Yeah,
But
so-
anything new, they have to run through the committee.
If I'm not mistaken, when an auditor sees a potential application of the GAAR, he or she will refer the case to the GAAR committee.
Yeah.
And it is those justice finance people that will decide if we apply the GAAR.
So somebody sits around a table and just goes through transactions and decides whether they're GAARable? Yeah.
like a bunch of
That's
people.
kind of a fun job.
Yeah.
A nice job.
Yeah. It's the same for transfer pricing penalties.
Right. Right. There's a committee.
committee for
to
that.
decide. Yeah.
So it's not just one person in its office deciding whether we apply the GAAR. It's really like a thoroughly decided.
It's a vetted.
Yeah,
It's a
vetted.
process.
It's a process.
Yeah.
Like senior officers.
Yeah. Good.
Of CRA and finance.
Good.
Taxpayers should be aware that the GAAR applies to an avoidance transaction. Who would have thought that the German avoidance transaction is for an avoidance transaction?
Breaking news.
Where is it?
Breaking news.
The GAAR applies to an avoidance transaction.
There's
Did
a GAAR.
you know?
Did you know?
There's more to know about the GAAR in a few minutes.
Raphael's a menace on the soundboard. So Renaud is not wearing headphones, so he's not benefiting from all of these sound effects. You can watch it back later. And you'll
All
hear
right, I
all the
will.
sound
I
effects.
will.
Suffice it to say, it's quite entertaining from my perspective, but
But I want to know, what is an avoidance transaction?
yeah.
An avoidance transaction is generally any transaction or any transaction in a series of transactions that results in a tax benefit, unless the taxpayer has made the transaction for a non-tax purpose. That is, the transaction is bona fide, or whatever you say it,
Yeah.
or genuine except for the tax benefit. So it must be a real transaction, or there is like a bona fide transaction except for the tax benefit. The transaction is bona fide
Made for a non-tax
except
purpose.
for the tax benefit.
That is, it is bona fide or genuine, except for, I think they mean other than, like outside of. So yes, there's a tax benefit, but yes, there can be a tax benefit as long as you still have a genuine or bona fide transaction. It's still okay. I think that's what they mean, except for. They just mean outside of or beyond.
Okay.
Beyond. They could say beyond the tax benefit. Beyond is better.
Beyond.
So if they said, unless, okay, this is generally any transaction that results in a tax benefit unless the taxpayer has made the transaction for a non-tax purpose, period. They could say, in other words, so long as the transaction is bona fide or genuine beyond the tax benefit it produces.
So,
Do you agree or no?
I'm kind of thinking, back in the days of the old GAAR, it was like primarily for a non-tax purpose, but now it's like one of the purposes is a non-tax purpose.
Yeah. Yeah, so you just need a genuine or bona fide transaction.
But there will always be a tax benefit
exactly,
from the
that's right.
transaction. So
Yes.
it's, beyond the tax
Beyond
benefit,
it.
there is a benefit.
Yeah, that's it.
Yeah, okay.
I think that's what they mean. Yeah.
Yeah. We're doing like CRA textual interpretation.
We are.
Okay, let's keep going. A tax benefit, what is it? It can include a reduction, an avoidance, or a deferral of tax or other amount, or an increase in a refund of tax or another amount. A tax benefit can also include a reduction, increase, or preservation of an amount that could, at a subsequent time, be used in calculating a taxpayer's liability, like the PUC.
Yeah.
When there is an avoidance transaction, the CRA may deny a tax benefit if the result of the transactions defeats the object, spirit, or purpose of the rules for income tax. So it seems like a CRA thinks it's object, spirit, or purpose.
Or, yeah.
There's an or.
You just have to defeat one of them.
Can you defeat the object without defeating the spirit?
I don't know. What even
The question
is
in
an
this
object?
case, what is the spirit of the law? What is the spirit of the ITA? What is the object and what is the purpose? Is it different? Is it the same? Who knows?
What even is an object? What is a spirit? What is a purpose?
What is the spirit of the law?
Okay, let's let Renaud read some
Yeah,
examples.
so that was
Shall
the
we?
introduction. Okay,
Yeah,
what
very
we
good.
have to know about the GAAR?
Yeah.
They said that without really saying like the 3 steps for the GAAR.
Yeah, they didn't lay out the test. It's really a preamble. It's really actually this is providing the object or the spirit or the purpose
Yeah.
of the GAAR legislation. Yeah. Yeah.
Can you defeat the object, spirit, or purpose of the GAAR itself?
That's a good question. Yes.
Can you GAAR the GAAR?
Can you GAAR the GAAR? Can you GAAR the GAAR of the GAAR? Maybe.
All right.
Examples of when the CRA would apply the GAAR.
Okay.
Generally, the CRA considers applying the GAAR whenever a taxpayer makes a transaction mainly to avoid, defer, or reduce tax, and that transaction results in an outcome that is inconsistent with the object, spirit, or purpose of the relevant tax rules. The following are some examples of tax avoidance schemes where, in the CRA's view, the GAAR should apply. It isn't an exhaustive list of circumstances in which the CRA will apply to the GAAR. Furthermore, all organizations' names, transactions are stylized examples. Any resemblance to actual organization or actual transaction details is purely coincidental. The examples are not meant to limit in any way the position that the Crown could take in respect to the GAAR in new ongoing cases. Now that the boring stuff is said, we can get to it.
Okay, you know what this reminds me of? It's like an ad for like a drug with the side effects. Or it's like when they start a sitcom and they say none of the characters are real. Like I think South Park starts with this, like any similarity to a real person is purely coincidental.
Yeah, there's
Yeah.
a bunch of series. The first, like, there was a warning at the beginning.
Yeah.
It's like, this is not about real life.
Yeah,
This is not about real people.
right.
It's all coincidence.
It's just
If ever
coincidence.
it's the same,
Don't-
it's
don't-
not
don't
our
sue us.
intention. Don't sue us, please.
Don't sue us. Okay.
All right. Taxpayers, including in-house tax advisors and the audit committees of public companies, may want to consult these examples to determine whether any tax planning they are contemplating is similar. The income tax treatment of particular transactions proposed by the specific taxpayer will only be confirmed by the CRA in the context of an advance income tax ruling. Requests submitted in the matter set out in the Information Circular IC 76R12 advanced income tax rulings, and technical interpretations. Another tongue twister.
Yeah.
If you are aware of examples of transactions to which the CRA should consider applying the GAAR, you're invited to send them to this link.
Interesting.
CPILBDISSUG
Holy
at CRA.ca.
Whoa! Look at that acronym. That is insane.
That is crazy.
What do you think it stands for?
I don't know.
CPILBDISSUG. CPILBDISSUG. Holy. Okay,
That's really like a pharmaceutical. It's like if you're aware of this about transaction which secret and applying, you're invited to send them to CPILBDISSUG at CRA.ca.
wow. Okay, we need to make an ad. But anyway, this is for whistleblowing. So if you are aware of somebody doing something, you could send an email to this address and say, so-and-so, my neighbor is doing this thing. You should GAAR them.
It has come to my attention.
It has
that
come
there
to
is
my
this,
attention.
Aggressive tax planning that my neighbor is doing, and I would really appreciate if you could GAAR them.
Yeah, like if somebody at a party starts telling you about some creative accounting they are doing, you'd be like, let me just consult the CPILBDISSUG at CRA.-arc.gc.ca.
It's like, hey, I found a way like to multiply the puck.
Yeah. Well, let me take to my email. CPILBDISSUG at CRA.-arc.gc.ca.
And you don't want to be wrong, because if you have a letter wrong, it sends to
You
someone
said,
else.
I don't know who's getting your. Oh my gosh! Amazing.
You could be like that one corporation who makes like all the emails that are not this one, so that they know if they're getting snitched.
Oh.
That's good.
I may have to set up. Okay, which letter is likely to be mistyped or missed in this? We got to make that.
Maybe the double S.
Somehow.
I really want to know what it stands for.
I do too. Okay,
I'm
so
trying to find
stay
it.
informed. You sign up for our newsletter. Blah blah blah. Let's
Blah,
go
blah, okay.
on to the first example. Scroll down. Let's scroll down.
Surplus stripping.
Yeah. This is fun because we're gonna do this in class, so you get to see this ahead of time. Okay, go ahead.
It's targeted abuse.
Yep.
A transaction for the benefit of a shareholder who is an individual and a non-resident taxpayer that results in the withdrawal or potential withdrawal of surplus regained earnings of a corporation in a manner that reduces the tax base and or a return of capital in excess of the amount that reflects the investment made with after-tax funds.
Okay.
Okay.
And
So okay.
okay. And here's where the abuse
Okay. So
lies.
let's just make sure.
Okay.
Let's just put this into English first.
Yeah, sure.
Okay. We have a shareholder who is an individual or a non-resident. Okay. And what they want to do is take retained earnings out of a corporation in a way that reduces the tax base and or a return of capital in excess of the amount that reflects the investment made with after-tax funds. Okay, let's look at the first one. Withdrawal of surplus retained earnings of a corporation in a manner that reduces the tax base. What they're saying is, if you're an individual, okay, it's easier if you think of a non-resident. I think this might be easier. If you're a non-resident and you withdraw, and you have a Canadian corporation pay you a dividend, there's going to be a withholding tax on the dividend. The corporation has to pay a withholding tax. But if you're a non-resident in some countries with a tax treaty, and instead you're able to sell the shares, instead of having the dividend paid out, you can sell the shares at a profit, and that profit is capital gain, there's not going to be a withholding tax. So if you do a transaction where the corporation does some like reorganization to make it possible for you to sell your shares, instead of paying you a dividend, specifically to get those earnings out as capital gain instead of a dividend, that's one type of targeted abuse here. And the second one is PUC. If you do something that reduces the tax base and or, okay, see the and or a return of capital in excess of the amount that reflects the investment made with after-tax funds. The amount that reflects the investment made with after-tax funds, that's usually considered, that's what we talk about when we talk about PUC.
Yeah.
Yeah. So if you find a way to return capital above what should have been your PUC, your limit, and if you find a way to do that, then that's a targeted abuse.
Yeah.
Yeah.
I googled
More or
the
less.
acronym, and
Oh,
the
yeah.
only result is this webpage.
No. So it's a mystery acronym.
It's a mystery. Yeah.
Okay. All right. So you don't have to know everything about corporate tax in order to understand the targeted abuse, but I would say this is you have to know some stuff in order to understand this.
Yeah.
I would say, yeah.
And I guess the scenario would be avoiding 84.1, where ACB and PUC is
Yeah.
readjusted to make
Yeah.
sure you don't have extra PUC.
Yeah, and I'm about to give you a spoiler alert. We're about to see and instead of or.
Oh no.
Get ready. Okay, so let's look at the abusive arrangement. And we actually have a little
A little example. Look at
example,
that.
yeah, a little diagram. Okay, so
All right.
let's see. Yep.
Transactions undertaken to strip corporate surplus in a manner that defeats the object, spirit, or purpose of
Not
section
or.
Oh, and purpose.
and purpose of sections 84, 84.1, and 212.1, and subject to section 89.1 of the Income Tax Act are subject to the application of the GAAR.
I have a theory. I think you defeat the object of 84, the spirit of 84.1, and the purpose of 89. I think that's why it's the end.
What about
here.
212.1?
That's international. It doesn't
Oh,
matter.
that doesn't matter. Okay, I just want to take a note just for students who don't understand why I push the correct naming of statutes, that the CRA uses the proper naming of the statute here, the unit, so that you don't have any mistake about where you are. It's subsection 89.1, not section 89.1, not S 89.1, subsection 89.1, because that is the correct naming provision. Okay.
Let's
okay.
look at the example.
Yeah, let's look at it.
It's scenario number 1. So first step, individual holds high ACB Class B shares on which the capital gains exemption was previously crystallized.
Oh boy.
So you have Class B shares. They have a high ACB.
High cost basis.
Because adjusted cost base, because you crystallize gains to use your exemption. The first 1.25 million is tax free. In a small business,
But
that's not the
how would you have
definition.
crystallized them?
Well, you just change the value from your normal Class A shares to Class B shares with a redeemed value of whatever you want to
So we've already
crystallize.
done like a share swap.
You
is
should
what
do
you're
a
saying.
share
Maybe an estate freeze.
Share swap, estate freeze.
Yeah.
And you crystallize the gain to be able to use your exemption.
Great.
so far that's okay, because you just
Yeah,
trigger the gain to use your exemption.
you're allowed
but there
to
was
do it.
no taxes that
Right.
should have been paid. You just trigger the gain.
Yeah.
And you use your exemption that you are going to use in the future anyways.
That's it.
So that's fine. That's fine.
That's totally fine.
It doesn't frustrate the object, nor the spirit, nor
Nor
the
the
purpose of any provision of the act.
Correct.
Okay,
All right.
B, 2.
Step 2, subsidiary companies, subco, transfers property A to holding company, holdco, in consideration for Class B shares of holdco.
Okay. So
Subco
this is
property.
this is holdco, and subco is below holdco,
Class B shares.
and subco is going to transfer property up the chain. So it's going to be how do you call that when each one owns some of the other? It's the circular holding. Yeah, they have all kinds of terms
Yeah.
for it.
Incestuous
Yeah,
relationship.
yeah.
Okay, so subco.
Habsburgian shareholding. Yes.
Okay, so subco owns holdco.
No, look at the drawing. Holdco owns subco, and subco is going to transfer property so that it also owns holdco. That's why it's Habsburgian. Holdco is going to hold subco, and subco is going to hold holdco in the amount of property A. It's already completely dodgy. I'm sorry, anybody who tells me, oh, well, there's no space for a GAAR, we shouldn't have a GAAR because people should be allowed to arrange their affairs. Okay, well, look what you arranged. Look what you have arranged here. Come on.
Because you're just trying to. put
Let's look at the
property
image,
A
just
and
out of
holdco in that
curiosity.
subco.
What does the image description say? Click on image description. What does it say?
This is a
No,
dodgy tax. No.
do the first. Do the first one. The before image shows the situation before entering the series of transactions. An individual holds common shares and Class B shares of holdco. In turn, Holdco holds Class A shares of Subco. The common shares of Holdco have nominal value. The Class B shares of Holdco held by the individual have a fair market value of $4 million and adjusted cost base of $750 because of a previously crystallized capital gain exemption, and puck of $1. Subco holds property A with a fair market value of $925. Okay, so, okay.
Why is there so much
There's a lot of
information
detail
in
here.
the description?
Yeah, it's like, wow. Okay, so then let's go to the after image.
Yeah.
The after image shows the result of the transaction in which Subco transferred property A to Holdco in consideration for Class B shares of Holdco. Right? This transaction resulted in an increase of the puck of the B shares held by the individual up to $750,000. Aha, it's a puck duplication strategy. So what they did in step one, step -1, like before this transaction, they had the individual owned all the shares of Holdco, and the individual gave themselves a purchased preferred shares, holding all of the future value in the preferred shares. You want to add to that? Yeah, go ahead.
It's just that the puck of the B shares is $1.
Yes.
And now the puck of the B shares in aggregate is the value of the property.
Yeah, because of this mixing of the puck in the class. Pretty complicated for a beginner, I would say. That's pretty complicated.
That's number one. It should be the simplest.
Eh?
It should be the simplest. This is just
I know.
transaction one.
I know.
Okay, do we get where we are? It's just that we had a puck of $1, and because puck is the aggregate amount of all the puck in all the shares
Of the class.
it's
Yeah.
basically you have a bunch of shares where the puck is $1, and now you have a bunch of shares where the puck is $925,000. So the puck together is $925,000 and $1. And so the individual who owned a bunch of these shares now has a puck in the aggregate of the $925,000 of whatever fraction of this is his shares. So now he has a puck of, according to calculation by the CRA, $750,000 that can be taken tax-free.
So the idea is that we already took out all of our tax-free puck
Yeah.
in the crystallization transaction. And now we're shuffling the deck underneath to move puck from the lower tier up to the higher tier where we can share it with the $1 puck shareholder. Woo! Wow.
But the question
they
is-
came out of the gate strong with this.
Yeah. I mean, how come, when I see plannings like that, I'm like, how come 84.1 doesn't, it prevents this in the first time, in transaction, in the before transaction.
Yeah.
84.1 apply to ensure puck is $1.
Yeah, it reduced that when you withdrew, it reduced
Yeah.
your puck down to $1.
But
So it
now,
worked.
because you're doing it in the two corporations
Yeah.
below, 84.1 doesn't apply anymore because there's nothing out.
Right.
But it's
But
clear.
you need GAAR to stop this,
You
apparently.
need GAAR to. I mean, couldn't you find another way to stop this?
Maybe you could, but if you write the preventive rule into the act, you'll have an act that's 1,000,000 pages long
Yeah.
instead of a few
Well,
hundred
I have
pages.
a question
several
about
hundred.
this. Could you write, like, tax policy in the act? Can you write that? For example, if you think about COP 4, there was nothing in the act to prevent this. But couldn't
Right.
you write like a broad provision saying, there is a principle against
Yeah.
having more POC than the investment you put in the corporation? Well, it should be better than that. But could you have sort of a conceptual tax policy laid out in the act that would help us apply the GAAR when we don't know what the tax policy is?
Yeah.
Like in
Especially with PUC. I think
in
PUC
DAC
is,
also.
Yeah, yes, that's right.
If we had a provision in the act saying, okay, we don't want you to defer taxes through a privately owned corporation somewhere in the act, or it could say through a CCPC or whatever, if we had those clues in the act, it could help us
Yeah.
understand more, because now we just rely on literal interpretation
Yeah.
and literal rules.
Yeah.
They're very easy to circumvent.
I think that I will say I think the danger always is you write a policy in the act and the taxpayers are going to dance around it and dance on top of
Yeah.
it and twist it and turn it. Well, you said this, but you didn't say that, or you said it this way. You should have said it that way if you meant to catch my transaction. So you're going to end up in the same place, which is GAAR.
But it is what case law does in GAAR.
Yeah, for
Where
sure.
you have a court
sure.
saying this is a tax policy behind the provision. You cannot do that because this is a tax policy.
Yeah.
So we kind of have this conceptual analysis, but not in the act,
Yeah,
in the
that's
case
right.
law.
Yeah.
I think we still have it.
It's still there. Yeah, I agree.
It's just not the parliament that decides, it's the courts.
Well, it's interesting that this is just showing you the abusive arrangement, and then they move on. Like,
Yeah.
they're not telling you anything more than, hey, look at this scenario. This scenario
Why
is an
it not
abusive
acceptable?
arrangement.
Why is this unacceptable?
They don't say.
It's like, it is. It is because we are saying it
We're
is.
saying it is.
We
We're
don't
just
like
putting you in,
this.
it's like a dirty dozen kind of list. It's just telling you, like, these are bad. Don't do these.
This is, don't do this.
Don't do these things. All right, transaction 2. Give it a shot. Renaud, what you got?
Number
All
2.
right. First step. Canco redeems the preferred shares held by the individual, triggering a deemed dividend of $849,999 and an equivalent capital loss, which is added to the ABC of the common shares under subsection 43.6. 40 brackets 3.6.
Canco redeems preferred shares. Oh, is it the same transaction? No, it's scenario 2.
This
No,
is
it's
completely
another one.
different.
Okay, Canco redeems the preferred shares held by the individual, but we're talking about a
What
wholly
shares?
new.
Which shares? Where are we?
What?
Okay, the before image depicts the following.
Oh,
the,
good.
The individual holds common shares and preferred shares of Canco. The common shares have a fair market value of $850,000 and a nominal ACB, so a dollar of ACB. The preferred shares are shares on which a capital gain exemption was crystallized. Hence, the POC of the preferred shares was $1, and the FMV and the ACB were $850,000. Circle number 1. Oh, no.
There's
Circle number
circles.
1.
There's like a little purple circle. Yeah.
I kind of, that's my... Okay. Circle number 1 shows the preferred shares being redeemed. The green rectangle on the left shows that the capital loss is added to the ACB of the common shares held by the individual. Circle number 2 illustrates the transfer of the common shares to Holdco. What?
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 We are not going to get through this. We were only going to spend an hour today.
So Kenco redeems shares. Okay, 2 individual transfers. The individual transfers their common shares to Holdco in consideration of preferred shares with an ACB and redemption value equivalent to $850 and a nominal value common shares. Holdco redeems the preferred shares without any tax consequences. What happens?
What the heck? What the heck is going on here? Okay, Canco redeems the preferred shares held by the individual. I think it's the same scenario. I do. I think it's individual and Holdco from scenario 1, and it's the same scenario. So individual 1 has the shares, the B shares being the preferred shares. Canco redeems them, triggering a deemed dividend. Canco redeems them, triggering a deemed dividend and an equivalent capital loss, which is added to the cost base of the common shares under subsection 43.6. And then individual transfers their common shares to Holdco in consideration of the preferred shares with an ACB and redemption value equal to the $850 and nominal value common shares. Holdco redeems the preferred shares without any tax consequences. Whoa! Holy moly! The after image is the result of the transfer of the common shares to Holdco. The individual now holds common shares and preferred shares. The common shares have a nominal ACB and FMV. The preferred shares have FMV, POC, and ACB of $850. Oh my gosh.
Okay, so
Wow.
what happens is that
I do think it's the same as, I think it's the same.
It's very
no,
similar.
it's
No, it's
not,
not the
because the
same.
numbers are different.
And also,
Oh my gosh,
but
why
how
is this
come,
so...
How come the puck is so high?
This
What-
is so crazy. Why is this written this way? I don't understand.
That's really like general
This was to
guidance on the
help
GAAR.
us.
Yeah,
Ooh, sorry. It was in my phone.
it's like
Don't
general
worry.
guidance on the GAAR. Okay,
General
so we have
guidance
this
on the
crazy
GAAR.
transaction. We don't like that, and try to figure out the transaction. We're not gonna help you.
Best of luck to you. Let's go to 3 and see if 3 is any easier.
Oh,
Okay, try number 3, Renaud.
All right. I'll try to get
no.
to the end of it. Oh
crazy.
dear. There's
it's
diagonals.
already not nice.
Okay. By a series of transactions, Canco and Sumco, two Canadian corporations with the same corporate group that had been parent and subsidiary, became sister corporations.
This is Copthorne.
It's Copthorne.
It is
No,
Copthorne.
it's not
Yeah.
Copthorne because it's clearly not Copthorne.
Oh, right,
It's
right.
a coincidence.
Oh, yeah,
Whatever
right.
it looks like, it's not. Certainly not
Oh,
Copthorne.
This is Copthorne, but not.
Not Copthorne. So this is something that might remind you, maybe it looks a bit like Copthorne, but let's go back to the
Okay,
warning.
but you recognize this one now.
Yeah, I do, I do.
Yeah. Because now we have this sub going sideways, so they
And
can,
now they can amalgamate.
that's it, and they can combine their puck.
And then the puck doesn't disappear.
That's right.
Well, it should.
Exactly.
Any resemblance to Copthorne is
merely
purely coincidental.
coincidental. Okay, I caught up. I was like, what is going on here? Why are these so complicated? They're complicated because transaction scenario 1, 2, and 3 are
Okay, but
Copthorne.
can you imagine this is Copthorne in 2 steps?
Yeah, instead of 30, I think I counted 32 steps. Okay, fine.
okay.
But
So
again,
don't
there's
do
no,
Copthorne.
just don't do that.
We'll apply the GAAR.
We're gonna upgar you.
Yeah.
That's it. We're not gonna tell you what the right answer is or what the outcome is, but we're gonna gar you if you
And
do these things.
I really appreciate that they were not telling us why it
No,
frustrates
not even
the
a little bit.
object.
Not even a
No,
bit.
it's like,
Here's a transaction. It frustrates.
do these.
Period.
Yeah,
It's a
don't do
factual
these.
statement. Fascinating. Okay, continue, Renaud. We're doing awesome.
All right.
okay.
Now, there's creation of an artificial capital loss. The targeted abuse being the offsetting of a capital gain with an artificial capital loss, a loss that does not reflect the true decline in value, or a capital asset where there was no change in the taxpayer's overall economic power, which results in a misuse and abuse of sections
Well,
38, 39, and 40 of the Income Act when read as a whole.
Okay.
This could also be Copthorne, but earlier on.
100%. Exactly right. That is exactly right. You've got a good memory.
Here's the
Great.
abusive arrangement.
Here we go.
Transactions referred to as value shifts, where losses are created through a series of transactions designed to shift value from an existing class of shares to a newly issued class of shares. The initial shares are then sold to a non-affiliated person, resulting in an artificial capital loss that is used to offset a pre-existing or future capital gain.
Yeah, it looks really familiar, doesn't it?
Mm-hmm.
Yeah. All right. So then their example should, if we just think, now that you have, once you frame it, then you understand what's going on. Okay, so go ahead with the transaction. What's going to happen?
Step 1, an individual subscribes for a common share of Canco.
Okay.
Step 2, Canco declares a dividend on the common shares held by the individual. The dividend is payable by the issuance of preferred shares with high redemption value and low paid-up capital, commonly known as high-low shares.
Oh, there you go. That's a nice little thing to know. That's
Yep.
a high-low. That's
Yep.
a high-low. High redemption value, low POC.
Individual sells its common shares of Canco to a non-affiliated person for a nominal amount. The disposition results in a capital loss.
Okay. And that's
So far, so good.
Abusive.
That's simple.
that's it.
I
That's
would,
the-
yeah, well, so far.
that's
And
it.
why is this an abuse?
Well, let's look at the image description. The before image just depicts the following. Circle 1 shows an individual subscribing to common shares of Canco. The common shares have a high FMV and a high ACB, right? Because, of course, if about $100 in, it's worth $100 and its ACB is $100. Circle number 2 shows that a high value, low POC stock dividend is declared on the common shares of Canco. So I can pay you in stock, more stock of my company. And, of course, there will be no POC because there's been no contribution to the company, so it's going to be none or nominal POC. But it could be worth something because it's worth the residual value of Canco, and we're sending it out to you. And then image B, the after image depicts the following. Circle number 3 shows the sale by the individual of the common shares. Now that I have given you the preferred shares and they have all the value, now my common shares don't have any value. I sell those ones and I have my high ACB and I have a loss. This is a fun little game. This triggers a capital loss. Finally, the image shows the individual still holding the preferred shares of Canco, resulting from the stock dividend that have a high fair market value and a low POC. If you can figure this one out, you're well on your way to understanding corporate tax, and that's abusive. So moving on.
That's it. That's the
it.
explanation. It's
That's
like,
it.
this isn't abuse.
That's it.
Don't like that. That's it.
That's it. Okay, let's look at discretionary trusts.
And the application of the 21-year deemed disposition rule.
Okay, you know this rule?
I don't.
Okay, maybe we're going to learn it.
All right. Here's the abuse. The purpose of subsection 104.4 of the Income Tax Act is to prevent the use of trusts to defer indefinitely the recognition for tax purposes of gain accruing on certain types of property, mainly capital property. Subsection 104.4 generally treats capital property of a trust, other than certain trusts, for the benefit of the settler, for a spouse or common law partner of the settler, or for the joint benefit, as having been disposed of and required by the trust every 21 year at the property's fair market value.
Yeah.
So that was a lot.
Every 21 year, it's like you rebuy everything in trust.
Yeah.
So you cannot, because once you put money in the trust, it's a tax deferral that could be forever, because you will only be taxed when there is when the property or the income goes to the beneficiaries. So as long as it stays in the trust, you're not necessarily taxed on it. And so every 21 year, it's like you rebuy everything you have in the trust. Which makes sense. But of course, there will be ways to try to avoid it.
Yeah,
of course.
Of course.
Moreover, subsection 104.5.8 of the Income Tax Act is an anti-avoidance rule designed to prevent the avoidance of the 21-year rule through the use of trust-to-trust transfers that do not involve dispositions of property at fair market value.
Okay, so it's like I'm going to dispose it in favor of another trust.
Yep.
All right?
Yep.
As stated during the 2017 CTF annual conference, the CRA will consider the application of the GAAR where transactions result in the avoidance of the 21-year rule by trust.
Okay.
Here is an abusive arrangement.
Here comes one.
Here it goes.
So actually, if you were wondering, how do I avoid the 21-year trust automatic disposition rule? Here it comes. Here's how
Here
they
it
did
is.
it. And now you can't do this anymore. Okay.
So we have old trust.
Old trust.
All right. This planning involves a transaction or multiple transactions or arrangement designed to avoid or resulting in the avoidance of the 21-year rule by trust, whether these are situations involving the distribution of property from a family trust to a Canadian corporation with non-resident shareholders, or the distribution of property by a Canadian resident discretionary family trust to a Canadian corporation whose shares are owned by another Canadian resident discretionary family trust, circumventing the application of subsection 104.5.8.
Yep.
We
Okay.
have a little bit of explanation.
Yeah, we need step by step.
Well,
Okay.
I think the little scenario is going to show it to you step by step. But what do you say, Raphael? Can you give us the?
Well,
Can you vulgarize it?
It's simple. It's
Yeah.
just that so the way to avoid the 21 years is to distribute the property to someone. So this someone will be taxed on the property. But now it's like, instead of instead of distributing the property to someone else, I will distribute the property to another trust. So I will just restart the 21-year clock. And if I can do it indefinitely, I will never be taxed on the disposition of the property.
Okay.
So,
Yeah.
That's pretty much it.
Yeah, that's pretty much it. All right, so look at your transaction. Here you go, scenario. Oh, we got a couple of scenarios with a trust.
Okay.
So old trust.
So step 1, the old trust is approaching its 21st anniversary.
Yeah.
Canco is step 2. Canco is wholly owned by a newly established discretionary trust resident in Canada, a new trust. Canco is or will become a beneficiary of old trust pursuant to its trust indenture. And step 4, the old trust distributes its property with an unrealized gain to a Canco on a tax-deferred basis.
I think the
Canco. Yeah, that's
to
a bit
a
weird.
Canco? To
To
Canco?
Canco.
To Canco.
Yeah.
Yeah.
So
There's no a Canco.
No.
That's
No.
weird. And so that's it. So the
So-
trust disposes property to Canco, but Canco is owned by the trust.
Old trust distributes the property with an unrealized gain on a tax-deferred basis.
Yeah.
Rollover.
Over to Canco.
The trust rolls its property into Canco on a tax-deferred basis. Then now Canco has the property, and now Old Trust doesn't have the property anymore.
Yeah, but look, who has the property? New trust.
New trust with the same beneficiaries, presumably. Yeah.
We kind of need a
is
step
way too easy.
1.1
I know.
here, where there is a new trust that
Also,
is
I
established.
feel like they do it backwards. I feel like they just do it backwards. Like, it's not backwards. Like, Old Trust has property. If Old Trust does nothing, it's going to be treated as if it has been sold and it's going to trigger the gain. Look at the gain. It says ACB low, fair market value high. So it doesn't give us a number, but it just says there's going to be gain. So instead of doing that, I just roll the property into a corporation on a tax-deferred basis. That's meaning that it's bizarre that you could do this rollover, though. How do you do that rollover? They don't explain. But let's assume that you can roll it into Canco and no longer have any interest. The old trust does not have an interest, or it does have an interest in Canco. They must have shares in Canco if they're doing a rollover.
They must have shares.
They must get a
so
share.
I don't know what they do, but
now
Old Trust.
So Old Trust has, I mean, you could do this infinitely because you could just now roll Canco into another Canco and you could just keep it going forever. And you would just have each time you would have a share of a new one, a new intermediary. It's completely silly. I can't believe this would ever work, but apparently it must have worked because it needed a GAAR to stop it. So let's go to
Why do
scenario.
you need a guard to stop this?
Yeah. That is a
Scenario
darn
two.
good question. Okay, so now, oh boy, now we see 4 in Canada, so now we're going to
Oh,
get
no.
into exciting.
Oh, boy.
Yeah.
We have the same problem. Our port trust is approaching its 21st anniversary.
Yep.
Step 2, Canco is wholly owned by the non-resident beneficiaries of Old Trust.
Yep.
Canco is or will become a beneficiary of Old Trust pursuant to its trust indenture. And then step 4, the property held by the Old Trust is distributed on a tax-deferred basis to Canco.
Yeah. Okay, so same exact idea. The property in Old Trust is about to be deemed to have been disposed. Now we're going to create Canco, and we're going to distribute. Isn't this exactly the same?
It's exactly
Yeah,
the
the
same, but
same.
it triggers a Part 13 tax because the
Because
beneficiaries
we
are
have
non-resident.
foreign beneficiaries.
Yeah.
Okay.
That's it. It's the same.
I'm not sure why there's not much juice to that squeeze. Okay, so exact same scenario, just with some foreign beneficiaries, and you're abusing more
I mean,
provisions.
Why would you accept that you can roll the interest in the trust after 21 years? Like, shouldn't there be an overarching principle?
Isn't this
that-
like a rule? Yeah. I agree.
Why is the rollover working if we don't want you to be able to be deferred taxes?
Yeah, so
on
I
that
think this is a
property?
constant question for me with GAAR. It's like, if you know that this is an issue and if one is doing it and it's risen to the level of the knowledge of the CRA, write the rule to prevent it? Are you going to rely on GAAR? we're gonna do GAAR committees. We're gonna like perpetually play this cat and
Yeah,
mouse.
but at the same time, like as a practitioner, if you see this web page, you cannot be like, I didn't know that the CRA will assess you.
Fine.
You have to tell your client the CRA will GAR you if you
Yeah.
do this.
Okay.
And so your client's gonna be, no, I don't want GAR penalties.
Yeah, fine.
So,
Fine.
I mean, in that case, why would you ever write specific anti-avoidance rules in the Act if all you can say is I will apply the GAR? In what circumstances do you want a specific
Remember,
anti-avoidance?
that's actually what happened when they first adopted the GAAR in 1984. Parliament dropped a bunch of SARs, special anti-avoidance rules, because they thought, well, we don't need special anti-avoidance rules anymore. The GAAR will apply. And then they realized the courts do not like to apply the GAAR, or they apply them inconsistently, and so they started adding those SARs back in again. Yeah. But those first couple of cases are fascinating for that reason. Yeah. Okay, so that's it. That's abusive. Don't do that.
That's it. Don't do that. Don't try.
Don't do
to
it. Don't
avoid
try
the
it if
21
you're a
year.
resident. Don't try it if you're a non-resident. That's pretty much it.
Pretty much. And then here's another fun thing that we'll learn in corporate tax, which is the stop loss and
Okay.
loss shifting. Okay, so avoidance of the stop loss rules.
All right, subsections 93.2, 93.2.01, and 112.3 of the Income Tax Act express a statutory scheme that revealed the existence of a unified policy within the Act in relation to the limitation of capital losses that may result from the dispositions of shares of a foreign affiliate or Canadian corporation by considering non-taxable dividends previously received by the corporate shareholder or taxpayer.
So those provisions
I
they
need to send,
repeal.
I need to send my really basic rules for writing good papers in law school to the people who write these things, because this sentence is 10 lines too long and it's only 4 lines. There's too many. Okay.
Reveal the existence of a unified policy
Wow.
within the Act in relation to. It's not a policy in relation to. Explain what the policy is.
It's a revealing the existence of a policy, my friend, okay?
It doesn't express the policy.
No,
it
it's
expresses
revealing
a scheme
the existence
that
of a policy.
reveal. But it's not the provision that
It's
reveal
not
the
even
policy.
revealing.
It's
expressing
scheme.
a scheme.
It expresses a scheme
And the scheme reveals the existence of oh my
of
word.
a unified policy
Oh my word. Okay.
in
What
relation
I'm trying to
to
say.
the limitation of losses that may result from disposition of shares.
Oh my gosh.
We don't know what the policy is, but
No.
the policy is in relation with something.
No, there's nothing said about this policy. Oh, that is. Yeah. Oh no. Yeah, this is not. I don't love this. Okay, this is actually frustrating, right? Because, okay, there's a scheme that limits capital losses. Okay, and the scheme, there's a reason that we have this scheme for limiting losses. What is the reason we have this scheme for limiting losses? Nobody knows. Nobody knows. It is not revealed here. It is revealed in the statutory scheme itself. That's what we're being told here. Okay. And what is the limitation? That it will, when you have non-taxable dividends previously received, then if you later try to produce capital losses, you're going to have those capital losses denied. That seems to be the rule.
That's it.
And so what you need to know is 112 is a dividends received deduction. If a corporation receives dividends from another corporation, it's not taxable. It's taxed, included and then deducted from your income, so it's tax-free. And what they're saying is, I'm going to take away that tax-free dividend receipt if later you produce a capital loss and try to take the capital loss. No, I'm going to go back and take away your tax-free dividend somehow. Okay, so there's a rule to stop you from doing something because for reasons. And here comes the abusive arrangement that tells us when you are violating the policy, unified policy that exists, which is revealed by the statutory scheme.
If I would write this in a paper, is that an A+?
Yes. Yes. Please, somebody write it in a real way that I can read it. Yes, that would be great. Okay,
Okay, let's look at the example.
let's look at the
All
example.
right.
I know.
A transaction. Here's the abuse. A transaction or series of transactions that result in a capital loss on the disposition of shares of an entity that had previously paid tax-free dividends in respect of those shares or on shares for which they were substituted.
Okay.
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 Okay. Cool.
So here, look at this crying. Oh my goodness. Okay. The foreign affiliate has surplus, meaning it has profit that it's ready to distribute and could distribute as a dividend. Okay.
And foreign affiliate distributes to Canco the dividends. They're exempt. So
Canco gets to deduct those dividends, so it's a tax-free dividend to Canco. Then FA becomes a Canadian company.
what?
Okay. And Parent Co. subscribes for preferred shares of what used to be FA.
Okay.
And then we wind up, triggering a capital loss. What?
What? Okay, let's read the
Oh
image
my gosh.
description.
Read
Okay.
the- yeah.
The before image shows the following. Parent Co. owns shares of Canco, which in turn holds shares of FA. Circle 1 shows FA distributing some dividends to Canco.
So far, so good. I've got it.
So-
I understand.
So far, yeah. So far,
Yes.
100%. Everything is fine. Everything is easy. And then
Now FA is empty, right? It doesn't have any surplus profit. So that means its fair market value is the cost base.
Yeah.
Okay.
So let's say it's low. Let's say
yeah, it's low.
It's low.
Yeah.
But the ACB is high
But the ACV is high.
because you acquired the company at some point. So
Yeah, but
it's worth nothing.
Assume it's yes.
Well, it's just like on the stock market.
assume
in a
you
way.
wiped it. You just
Yeah.
wiped it out. Like you
It's like-
emptied it out.
It's like your company is worth $50. You paid $50 for it. You acquire it. You send the dividend of $50 to yourself. Your company is worth nothing anymore, but you still pay 50.
Yeah. I mean, I guess it's
But
possible to do.
it's like
Yeah.
the economic works because you got 50 out
Oh,
of it.
yeah.
But like, okay. Circle 2 illustrates the continuance of FA to Canada. Parent Co. owns shares of Canco, which in turn holds shares of Subco, formerly known as FA, that have a low FMV and a high ACB. So
Okay.
it's low-high shares.
So listen, just to be clear, Parent Co. already owned foreign affiliate indirectly.
Yeah.
It just in step 2 becomes a direct owner of the what used to be the foreign affiliate. It is now the
Doesn't
Canadian.
change
So.
much, but
No, but the point, I don't know why. Okay. Well, we brought it on shore so that we can take its loss.
Yeah.
That's why.
the after image shows the result of the transaction. Circle 3 shows Parent Co. subscribing for preferred shares of Subco. The FMV equals the ACB. Circle 4 shows Subco winding up. A capital loss is triggered on cancellation of the common share of Subco. Okay.
Yeah.
So basically, you got the money out, and
Yeah.
now you're trying to take the loss for the money you took out.
Yeah.
And this that triggers the GAAR.
Yeah. Somehow you need a GAAR
Fine,
for this.
fine. I mean,
Great.
don't you think is there not like a 55 something for that?
I don't know.
It's like
So I think actually maybe you were highlighting the problem is that a lot of our rules are so detailed that if you don't do exactly what those rules tell you not to do, then you're good. You can use POC, you can do these things, you can distribute things, you can do. You just get creative, and then the CRA figures out, hey, don't do that also. So anyway, the point is don't do that.
But it seems so obvious
I
that you
know.
cannot do
Yes,
that.
but only after the taxpayer does it, right?
Exactly.
Somehow.
But it seems it's like
I know. Don't they think of this when they're thinking about the
Yeah.
dividend
I mean,
distribution?
you're thinking about the dividend scheme, and you're like, what if someone
Yeah.
just sends dividend
Yeah.
back and then
Yeah.
cancels the shares? So
Right.
now you get the dividend and the
Yeah.
loss to just offset the dividend.
Exactly.
I-
Okay, how much more of this here is
we
here?
don't
Because
have much.
are we almost there? Because
have
we
Trini.
said we were gonna close this up in an hour, and it's been an hour.
Okay,
Let's go.
Let's go.
Let's read it. Treaty abuse.
Treaty.
I don't think we're at treaty abuse.
We are at treaty. You lost trading.
Oh,
Lost trading.
Yeah, I
what?
think-
You skipped treaty abuse.
Oh, treaty abuse.
Oh, there we are.
Yep.
All right. Canada has one of the largest networks of bilateral tax treaties in the world. While Canada is prepared to reduce the level of Canadian tax imposed on residents of trading partners by concluding bilateral tax treaties, It is not prepared to extend these tax treaty benefits to third country residents who indirectly access these benefits
So
in an
contrary
abusive
to
manner.
Justice Iacobucci, we do have a policy against treaty shopping.
Yeah,
Who knew?
that's new.
The
That is-
website says,
CRA says.
CRA says.
yeah, he. Oh wait.
Treaty abuse.
Can occur
Yep.
when the primary purpose of certain transactions is the securing of a more favorable tax position, and obtaining the more favorable treatment would be contrary to the objective and purpose of the relevant positions in the Income Tax Act and/or the treaties.
And or.
Okay,
And/or.
Okay, is there going to be a Luxco Barbco or example here?
We'll see.
I feel like this is certainly not Husky.
Certainly not.
Or Prévost.
Any
Certainly not.
similarity is purely...
Okay, and now my favorite sentence is coming.
Okay, here's the abusive arrangement. The CRA will consider the application of the GAAR to tax avoidance transactions undertaken to secure a tax benefit afforded by by a tax treaty. The CRA may apply the GAAR even when a non-resident would otherwise satisfy all of the treaty's relevant positions, including residency provisions, specific anti-avoidance rules, limitation on benefits provisions, and any other anti-avoidance provision, including the principal purpose test in Article 7.1 of the Multilateral Instruments in respect of the Tax Convention Act.
Can I have the example of when you respect all the possible anti-avoidance measures in the treaty, including the MLI, but the GAAR still applies? Like, the MLI is broader than the GAAR.
Yeah,
I
don't-
think.
yeah.
The PPT is
PPT
broader than the GAAR.
Yeah,
So
because it's principle,
Like-
not one of.
you respect beneficial ownership, you respect one of the main
Yeah.
provision in the MLI.
Yeah,
You're a resident, it's the right treaty that applies.
yeah,
You're not, assumably you're not doing treaty shopping if you respect
Right.
all these.
right.
But the CRA is like, we'll still apply the GAAR.
We'll still apply the GAAR.
I want to know what
I wanna know
is
too.
the example.
Well, let's go see. Okay.
A determination by Canada's competent authority. Oh, you went too far. Oh my. Okay.
Okay. I will not move anymore.
That a particular non-resident is entitled to the benefits of a treaty does not preclude the application of the GAAR to transactions undertaken primarily to secure a tax benefit afforded by the treaty. I wonder if that was
What?
applied in all cases. Spoiler, it hasn't. I don't think so. Moreover, consistent with the Information Circular 7117, the Canadian Competent Authority will not negotiate cases where the reassessment or assessment relies on any anti-avoidance provisions of the Act.
All right, let's see the transaction.
All right, very simple, only one sentence. Let's see it.
Wow.
A person who is not entitled to the benefits of a tax treaty uses an intermediary entity entitled to such benefits to indirectly obtain those benefits,
Wow.
resulting in a reduction of the amount of withholding tax otherwise payable under Part 8 of the Income Tax Act.
13.
The X is a 10.
Oh,
so that's
13. Oh,
yeah.
sorry.
No, don't worry, don't worry.
Okay, so that's treaty shopping in
That's
a
treaty
nutshell.
shopping now.
In the intermediary. That's it.
Yeah. So if you set up in Luxembourg and you invest in Canada, treaty shopping.
So although energy doesn't work.
Oh, wow.
Ooh.
Wow.
I'm not sure this is what they're saying,
I'm not
but
sure
this is what
either.
they're saying.
It does seem to be what they're saying.
As long as you have an intermediary to do treaty shopping, to use a better treaty, you are in the GAAR area. Or presumably in the MLI, I'm not sure. But
I think this was the most understandable of all the abuses.
Yes,
Yeah.
and yet it was the most misrepresented.
Lost trading.
okay, last one. Last
one.
trading.
Lost trading.
All right. The object, spirit, and purpose of subsection 111.5 of the Income Tax Act is to prevent lost trading between unrelated parties. We like those. Subsection 111.5 generally restricts non-capital loss carryovers for a corporation if control of the corporation has been acquired by a person or group of persons unless it continues the same or similar business that incurred the losses.
Yep.
And I think for the transactions, any resemblance to Dean's Night
Is
a
purely
coincidence.
coincidental.
Purely a coincidence.
Or Duha.
Or Duha.
This is really Dean's Night, like the convertible debenture.
Yeah,
like
I'm pretty sure
they
this
put a convertible debenture in
And they
that.
have a promoter.
Okay.
Like,
Totally. Yeah,
I mean,
so
is it Matco?
Gee. No, it's called Finco, so therefore it's not.
It's not
Matco.
Matco. Not Matco.
Okay, so go ahead.
Let's see it. First, incorporate Nuco.
Yep.
Okay, this is really out of the blue. It's
Wow.
like, woohoo.
They're putting way more substance in those analysis.
Incorporation of
That-
Nuco. It's like, who's Nuco? I don't know.
Second, public exchanges shares of Losco with shares of Nuco.
Yeah.
Okay.
Losco transfers its assets to Nuco for a fair market value.
Yeah.
Sorry. Number 4, promoter Finco invests amount.
Basically, you don't even have to read this. You know what this is.
This is
It's Dean's Night.
It's purely
It's Dean's
Dean's
Night.
Night. And we kind of don't need the CRA to tell us that Dean's Night doesn't work. We have
It's
a
very
decision of the
strange.
Supreme Court.
Yeah, but
Like,
it's
no
almost
one's
like
doing it again.
same as no one should be doing Copthorne again. Same
Exactly.
as nobody. Yeah.
Like, no one will do a Copthorne again.
Nor
the Supreme
Husky.
Court told us the GAAR
Not
applies.
to. Yeah.
Yeah, but the public doesn't know
Yeah,
to
maybe
read
that's it.
hundreds of paragraphs
Maybe
of
that's
Dean's
it.
Night.
Maybe that's the.
Do you have
simple-
anyone from the public who will read this and be like,
No.
Of course.
No,
Of
because it's
course this is
unreadable.
abuse. It's unreadable.
They tried.
You need a lemon tax to understand this.
Crazy. All right, let's go down to misrepresentation and penalties. And shall I read for a minute?
Sure.
And then you can finish us off again, Raphael.
Penalty.
Pursuant to subparagraph 154AI, one little I, the CRA may reassess a particular tax return beyond the normal reassessment period in circumstances of misrepresentation, quote, attributable to neglect, carelessness, or willful default, unquote, or where there is fraud. For a penalty to apply under subsection 163(2), a taxpayer must have knowingly or under circumstances amounting to gross negligence made a false statement or an omission in their return. The scope for their application the application of these two penalties is not limited to particular provisions of the ITA, but applies for the purpose of the ITA as a whole, including Section 245 of the ITA, aka the GAAR. Therefore, the CRA could consider the application of either of the provisions above to tax avoidance arrangements involving the application of the GAAR. Okay. So they're just putting us on notice. Don't knowingly do
It's
these
like,
things.
if you do these things, we're gonna assess a penalty. Mm-hmm.
Yeah.
Of course, if you do Copthorne, like,
Hello.
it's blatant. Like,
Shocker.
Of course, you cannot do
Yeah.
it.
Whether the subsection 163(2) penalty applies in a given case or whether there has been a misrepresentation or fraud in accordance with subparagraph 154A(1) is a question of fact that can be determined only after a review of all the facts and circumstances. For example, a penalty may be considered in a situation where the taxpayer has disregarded the jurisprudence confirming the application of the GAAR in circumstances similar to transactions undertaken by or with the taxpayer.
So what
But
we
then
just
again,
said.
the GAAR can trigger even on new cases.
Yeah,
Yeah.
exactly.
A GAAR penalty.
Yeah. All right, take
Since
it
June
home.
2024, the legislation includes under subsection 245.5.1 a penalty applicable to the amount of tax payable and to refundable tax credits reduced as a result of the application of the GAAR. The penalty applies to a transaction only if the transaction or the series that includes the transaction was not disclosed to the Minister of National Revenue. The amount of the penalty will be reduced by any gross negligence penalty calculated under subsection 163(2) with respect to the same transaction or series where the GAAR penalty applies. An exception to the penalty is available under subsection 245.5.2. Subsection 245.5.2 is intended to be a narrow rule that may apply in circumstances where a taxpayer entering into a transaction reasonably relying upon the current state of the case law and administrative guidance from the Minister of National Revenue. So this is saying, if ever you do something dodgy, tell the minister. And if ever you told the minister, you will not get a penalty.
Yeah.
So you have the
Disclosure,
choice between
yeah.
don't disclose it and hope for the best that
Yeah.
the minister will not
Play the lottery.
realize it, play
Yeah.
the lottery, or
Yeah.
disclose it and get reassessed.
Yeah.
I mean, if you disclose it, it's kind of, hey, I did something dodgy, minister. Can you please look into this? I don't want
don't
a
give us a penalty.
ruling, but I would really like to
Yeah.
get reassessed.
It's bizarre.
But
It's
we will not get a
bizarre.
penalty. I kind of don't like that just because, like,
It's a deterrent. It's obvious to me that this is saying the GAAR is a deterrent now.
Yes.
And the penalties are deterrents. You're not going to do these things because you're not going to do them and disclose. So therefore, you're not going to do them, because if you do them and you don't disclose, you're going to get hit with these massive penalties. You're just making it more expensive. So it's got a deterrent effect. And then there's the learn more. You can go find out more supposedly if you go hit some of these other things. And at the bottom it says, "Did you find what you were looking for?" Scroll down. There. Did you find what you were looking for? No. I did not. We still haven't found what we're looking for, which is some comprehensive guidance. I will say that I thought the examples were just bewilderingly complicated until I realized what was going on, which was that it's the case law.
I would say it's a missed opportunity, I think, for the CRA to tell practitioners, these are the transactions we will GAAR.
Yeah.
And what they told us is, well, you already know we are GAARing this transaction, so here's a reminder, by the way, about case law. And they could have said, this is Copthorne, this is Husky, and this is Dean's Knight. I think the series should
I'm not even sure it was Husky. I think it might have been Alta.
It's kind of both.
Yeah, anyway.
It's both.
It's
so vague that it's Prévost Caro, so in Velcro.
Yeah.
I think the series should take this opportunity to talk about planning that are not yet in front of the courts.
Yeah.
Like, hey, in DAC investment, for example, like, we don't like this planning, we will GAAR you if ever you do it.
Yeah.
And they're kind of waiting for people to disclose first.
Yeah.
I'm not sure why.
Yeah.
Because if you're a practitioner and you say a client, the client want to do something,
right,
and you're like, the CRA says publicly that they will apply the GAAR if you do it.
Right.
Do you still want to do it?
Right.
Of course not.
Of course not.
So,
of course not. All right, Raphael, take us home.
Okay, well, goodbye, everyone. Have a nice weekend. This was the tax files.
Yeah, it was the tax files.
Thank you, Renaud.
Thank you for having me.
Thank you, everyone. Thank you, everyone that was watching today. Please like and subscribe, and don't forget, be there next time.
Share with your friends.